As summer winds down and crisp autumn breezes begin to stir, the corridors of power at the Federal Reserve are abuzz with intense deliberations. At stake is nothing less than the trajectory of the American economy and the livelihoods of millions of hardworking families across this great nation. The Fed's policymaking brain trust, led by the stalwart Jerome Powell, must now grapple with a pivotal quandary: whether to wield a scalpel or a broadsword in its latest surgical strike against the insidious forces of inflation. The economic vital signs, while still robust by many measures, have begun to show signs of enfeeblement. The once raging job market has cooled from its feverish pandemic pace, with hiring decelerating to the most glacial clip since those dark days of 2020. Yet even these sobering statistics have failed to dissuade the doubting Thomases among the investor class, who seem skeptical that the Fed will opt for an overture of muscular rate-cutting aggression at its upcoming policy conclave on September 17th to 18th. This rift presages a heated clash of cerebral titans within the hallowed confines of the Eccles building. On one side stands the chairman himself, Jerome Powell, ever open to wielding the bludgeon of emphatic monetary intervention to ensure the central bank does not lose its footing in the perennial struggle to chart a middle course between the Scylla of runaway inflation and the Charybdis of economic stagnation. Arrayed against him are the fretful Sanhedrins and dithering Hamlets who, in the piquant phrasing of economist Diane Swank, are still waffling on a quarter point. The stakes could scarcely be higher. Under Powell's clear-eyed stewardship, the Fed was tragically tardy in quashing the worst inflationary conflagration to singe American pocketbooks since the bygone days of Reaganomics. Should they fumble the mantle again by moving with undue lethargy, the grim specter of spiking joblessness and recession may be unavoidable. Powell has got to be thinking about his legacy right now, and he's really got to nail this soft landing, cautioned Swank, herself a Cassandra among the economic augurs. Her words should give the chairman pause. For if ever a figure best rode the narrow valley between the lofty peaks of triumph and the abysmal depths of failure, it is he. The fateful choice vexing Fed myrmidons, whether to embark on a gradual path of small homeopathic rate cuts or to front-load the economic medication with more potent, upfront dosages, is sure to be a polarizing one, reprising the hallowed tradition of rancor that has ever attended monetary policy's seminal turning points. With nearly all metrics of commercial activity now locked in an unmistakable downdraft, a growing contingent of economic savants spy more menace in a gradualist approach than in seizing the tiller with adroit decisiveness. The grim reality is that mounting joblessness, if left unfettered, can swiftly transmogrify into a self-perpetuating cycle of misery as consumers rein in their spending, prompting another round of corporate workforce purgings. The ominous rise in unemployment, nearly a full percentage point above last year's nadir, has already tripped the Somme rule, a harbinger of recession widely followed by crisis weather watchers. It raises some serious questions, not just about this meeting, but over the next several months, intoned Austin Goolsbee, the esteemed president of the Chicago Fed, in a recent interview on CNBC's hallowed airwaves. How do we make an effort to not have things turn into something worse? A separate data deluge from the Bureau of Labor Statistics has added more kindling to the pit of economic anxiety. Their latest report revealed a precipitous plunge in job openings to a low not witnessed since the dawning days of 2021. The ratio of vacancies to unemployed Americans, which had seemed to defy economic gravity by soaring as high as 2 openings for every jobless citizen at the dizzying apex of pandemic-era labor shortages, has now returned to the more terrestrial realm of approximate unity. Both of these statistical sobriquets followed hard upon remarks from the Fed's commander-in-chief himself at the idyllic Jackson Hole Symposium in late August. There, amidst the crisp mountain elevations of Wyoming, Powell declared in a tone that brooked little dissent that neither he nor his fellow regents seek or welcome further cooling in labor market conditions. Powell is trying to pull the Fed in a dovish direction, opined Tim Dewey of SGH Macro Advisors, one of the more far-sighted economic lodestars. If the economy were to unexpectedly slow, your rates are too high to adjust to that, to soften that blow. The whipsaw reaction across financial markets in the wake of Friday's employment data served as a stark reminder of just how tendentious this monetary moment has become. The initial jobs figures prompted investors to ratchet up their wagers on a robust half-point rate cut, only for those ambitious bets to be hastily unwound mere hours later, when Fed Governor Christopher Waller cast cold water on the prospect of such an audacious move before additional data pichatritza in the coming months. But more revelatory numbers are nigh. The government's overseers of the statistical arcana will publish 2 more monthly jobs reports between the Fed's September confab and their next convoking on the horizon of early November. According to the bearish betting line, investors currently favor better-than-even odds of half-point cuts at both the November and December meetings. The Fed tends to be gradual, cautioned Stephen Juneau of Bank of America, displaying the judicious temperament that has ever been the watchword of his venerable institution. They don't want to send the wrong signal to the markets if activity is still holding up, and broadly speaking, the U.S. economy still appears to be doing fine. A quarter-point snip this month followed by a brace of half-point incisions in November and December would leave the Fed's benchmark rate mired in the 4% to 4.25% range, still markedly higher than the ratified bounds of neutrality, ensuring continued economic headwinds. Not all are swayed by the siren song of rate cuts. However, a contingent of Fed stalwarts has sounded the tocsin in recent weeks about the perils of loosening the monetary vice too precipitately, thereby providing an unwelcome jolt to reinvigorating the very inflationary forces they have labored to subdue. With the Fed's favored price gauge still hovering defiantly above the 2% bogey at 2.5%, this contingent can buttress their case. History shouts to us that loosening monetary policy prematurely is a dangerous gambit that can rekindle inflation and entrench it in the economy for many months or even years, thundered Raphael Bostic of the Atlanta Fed in a recent disquisition. Bostic and his fellow knot-girders can also draw sustenance from the resiliency of American employers, who have been loath to unleash a torrent of pink slips despite the slowdown in payroll expansions. Such firmness in the face of economic vicissitudes lends credence to the notion that the Fed retains ample headroom to navigate deftly toward the hallowed soft landing. For Jerome Powell, the fading fortunes of the labor markets risk squandering his crowning achievement. His Fed's campaign of overwhelming monetary hawkishness in 2022 and 2023, the most aggressive flexing of the economic biceps in nearly half a century, succeeded in cooling off the raging inflationary fires without immolating the broader economy. To finesse this homestretch without triggering an all-out recession would enshrine Powell among the truly legendary Fed helmsmen. Yet that enshrinement may well hinge on the fineness of the Fed's calibrations over its next few fateful policy meetings. For as the eminent Neil Dutta of Renaissance Macro Research reminds us, you should be going now when the increase in unemployment is somewhat more benign than waiting for it to become so obvious that you're already too late. In the marbled halls and wood-paneled offices where the leviathaness of monetary mastery ply their recondite calculations, this autumnal season takes on an aura of freighted momentousness. The economic fates of untold millions now hang in the balance, subject to the inscrutable alchemy of Federal Reserve decision-making. Will Powell and his conclave of soothsayers prove themselves up to the dizzying challenge? Can they thread the celestial needle, curbing inflation's corrosive spread, without consigning the nation's economic fortunes to a recessionary abyss? Such are the Gordian knots only the truly great central bankers can deftly untie. Much will depend on reading the economic augurs with preternatural discernment. The labor market's decelerating vitality could presage either a safe glide path to the sacred soft landing or the leading edge of a more precipitous slide. Deciding whether these are the opening flanks of a temporary soft patch or the vanguard of systemic economic atrophy will tax the Fed's divinatory skills to the utmost. Yet if the mandarins of monetary policy can meld the flinty resolve that tamed inflation's brazening surge with the deft, well-calibrated touch its endgame now requires, they may well inscribe their own names in the pantheon of legend. A skilled surgeon knows that cauterizing a malignancy often demands an initial outpouring of blood and pain before lasting healing can take root. So too may Powell's Fed need to first endure a spell of economic privation, the bitter tonic of elevated joblessness, in service of banishing the pernicious specter of entrenched inflation. Only then can the true remedies of robust growth, vigorous hiring, and revitalized consumer spending be allowed to course through the nation's economic lifeblood. The path forward will require deft navigation through a blizzard of conflicting signals and cross-cutting uncertainties. The Fed's own summary of economic projections foresees unemployment cresting above 5% in the coming years, a sobering omen indeed. Yet many private forecasters spy even stormier skies ahead, with the jobless rate potentially breaching 6% should a more severe downturn take hold. Such a drastic spike in the ranks of the unemployed could quickly imperil the social fabric. For not only would it extinguish the primary income streams for millions of households, the cascading loss of spending power could catalyze a vicious cycle of business contraction and ever deeper job cuts. A death spiral of this nature is among the most pitiless scourges an economy can endure.